What are the main regulatory challenges your clients are facing today?
Well, I think the principal challenge is the sheer scale of change that's underway. The phrase unprecedented is very easy to use, but I think that it's difficult to find a period in financial regulatory history that compares with the volume of change that's underway at the moment. You really need to go back to the 1930s, both economically and in a regulatory environment, to see a kind of a similar conditions that exist today. But history lessons mean very little in client engagement. What they're really interested in is what they're able to sell, who they're able to sell it to, and how they're going to go about continuing in their current businesses if they can. So really what we've been trying to do as a business is identify those areas that we need to concentrate on that actually become opportunities. And that if you look at what arose out of the history of the 1930s, the Volcker Commission, etc., you get the arrival of the SEC, you get the regulatory infrastructure that supports the growth of the markets really over the course of the last 80 years. And now I think you have a reframing on a global basis that creates a similar level of opportunity, but places a significant degree of constraint on the opportunities that our clients have. So we've tried to direct our attention to a number of key regulatory initiatives, where as a custodian bank, we might be able to make a distinctive difference. That relies on things like the AIFMD, the Alternative Investment Fund Management Directive. We think that there are items of significant concern to us arising from that process. But following the addressing of those concerns, we believe that there's a significant opportunity.
What are a few of the most significant challenges and why?
I think if you look at the global regulatory environment right now, there are probably three issues that are most concerning to the markets, to our clients. And that would be the Volcker Rule, which is part of the Dodd-Frank legislation in the US, FATCA, and the AIFMD, which Seán mentioned. Each of those have their own objectives. The Volcker Rule and AIFMD are rooted in the outcome of the financial crisis and the G20 looking for ways to regulate riskiness and behavior in certain ways. And FATCA is a slightly different beast in that it looks to, it's a tax proposition by the US government seeking to raise revenue. And in fact was a revenue offset in the higher bill. The interesting thing is that if you look at the Volcker Rule, it shows the interconnectedness of the financial industry, which adds to the scope of regulatory change that clients are facing. In that Volcker is a very well-intended effort to rein in the risky behavior of domestic US banks. But given the way it was written and the general interconnectedness of the financial industry, it has impacts well beyond its borders, which are quite worrying to the global industry.
So how is BBH responding to this?
We're responding in a couple of ways. One way is we've set up a dedicated discipline into looking at regulatory change. And what this does is it allows us to look holistically and globally at regulatory items to be able to understand what can impact our clients, what can impact BBH, and then what opportunities might arise from these regulatory changes. It's quite easy when you talk about regulation to get negative and talk about the negative consequences. But with all change, and regulatory change is no exception, there are opportunities. So what we do is we looked with our clients to see what those opportunities might be. For example, on FATCA, it's a huge administrative burden for a lot of non-US clients, and what we've looked to do is how we can partner with the appropriate people to present solutions to our clients. So we're working with Compliance Technologies International and helping to market a EW8 solution that will make compliance with FATCA a much easier proposition.
And what about AIFMD?
AIFMD is interesting. If you look at the regulation, it's really being driven by the European regulatory agenda, which is to increase investor protection, increase market harmonization, decrease systemic risk, and increase transparency. And through the AIFMD, when they've tried to accomplish all of this, there are potentially unintended consequences. And one of the hot button issues right now is this concept of increased depository liability. And our concerns around that really are around the knock-on impact to European investors and to our clients who provide solutions for those investors. What we don't want to see is a situation where the depositary and custodian are being inserted into the investment process and restricting opportunities to clients and to their clients, which would have a disruptive force on the availability of investment product to European investors.
So to summarize, what's the overall message to clients?
Well, I think when you're discussing regulatory change, there's an instinct to kind of bang the table and throw one's arms up in despair. But my observation is that in this business particularly, we've been governed by the gods of small things. and being able to work with a partner who can understand the nuance of regulatory change, what that means in adaptations to your business model, and how you would be able to take advantage and opportunity out of that, i.e. what do you have to do when you go back to work in the morning after you've dealt with the outcome. I think that that's an important element of doing business. And I think it's a kind of an instinctive muscle that we've decided to build through establishing this group, and we're hoping to disseminate that throughout our business operatives so that they can respond effectively and meaningfully to our clients and their needs in terms of what they're trying to do, because effectively there's a world that we've got to go out and deal with tomorrow.
Seán Tuffy, Seán Páircéir, thank you very much.